Wednesday, everyone. Again, I'm so glad to have all of you. Um, I'm again glad we have these our mini classes, and uh, we want to go outside the box and do something different than that we've done before. But I also want to continue our journey we started last week on um, explaining about more about options. And as I mentioned last week with the options, once you understand the concept, the basics of the buying and the selling part, especially the selling, I think you can build that foundation and do so many things that could be even independent of the markets. And that's my goal. So once you get really comfortable with it, and if you have to do more and more, um, that's fine. Just make sure that you understand the concept of what is actually selling options. So last week we introduced the selling puts, and I think that's even more important than the calls, uh, because what it does in the selling options, in reality, again, you are being the insurance company, you're collecting the premium, and what happens is in this case, your risk becomes quite a bit, especially if it's naked. Now, if you have a cash protected account and you have the large capital, then you can do with that what the strategy we suggested, finding out the stocks that you really like and you would buy them and you like to buy them at a discount, then this is a great strategy. But as I mentioned, now stock at any moment could news can come up. They could go to zero. We're hoping you that your fundamental analysis that they won't, but that's the risk you're taking. So you have to have a large capital. Today, I'm going to build on that and for sort of review what happened last week with the selling puts. And building on that, we're going to speak about vertical spreads, especially in the uh, uh, credit side using the puts, and how we can minimize our risk by understanding how the vertical spreads work. So let's review our last week's put selling strategy. And if you recall, I made one example, and that was the Uber. That was a September 18th, and I suggested to I bought five, and I actually added five right after, actually before our meeting, we had 10. We had 10 contracts, and it was, uh, again, we sold it put 25. I average price that I got in was 30 cents and 0.5. So let's say a little over 30 cents. I want to review that because I want, although it's September 18th, and I said, well, I would be happy even if it expired and it went below 25, I wouldn't mind owning Uber at 25. But what happened is, if the opportunity arises, I like to take the profits. And that's the main thing I want to instill in you. If I'm getting 50%, 70%, 80% on my money, you know what? Time is of essence. I want to take this money and use another opportunities. That's the goal. So I don't want to squeeze every penny out of this trade. So as you can see, I started with 10 um, contracts. I had shown you, I think if you recall, I immediately I put my targets in, and I put one at 50% at 15 cents, for instance. And you can see a couple of days later, it was at 15 cents. I was covered. I sold some at 10 cents. That was about 66% return. And then I sold the balance at 5 cents for about 88% in a week. So not a bad week. So I'm not going to wait till September 18th to squeeze one, 3, 4 more cents out of this and collect, that, going to 1 cent or zero. So I'm out of this position. As you can see, right after I got in, Uber was selling off. So what happened was we actually went to about 50 cents. I know maybe a couple of you actually got it in a good place. You got some premiums around this, which is wonderful. But I already had my fundamental reasons, which were, I mean, this is So we spoke about, at that time, Uber was at 29.73. And basically, as I had mentioned to you, I want to collect the premium. And our criteria was, number one, I want to make sure they do have a very low probability of getting there, which that's, we can use delta, which is in this case minus 12. That means there's a 12% of this being in the money by the time of expiration. I also looked at the probability, which was about 15%. So anything under minus 30 or 30%, anything under about 20%, I'm comfortable with that. I also suggested that I don't want to collect less than 20 cents or 1% of the stock price. So if it was, let's say, around $30, I like to collect 30 cents on my, again, this was not naked. I did have, it was covered, but even if it was naked, I want to make sure I collect enough premium to make it worthwhile. One good thing is, again, because of these competition and everything, there are no really commissions. So in the, a few years ago, that would have been a big challenge because then you have to, on top of what you're collecting, you have to pay commission. So really you want to make it worthwhile. So here, 30 cents, 10 contract, that's $300 collected. And my other reason was I want to make sure the spread is as little as possible. I mentioned again, 1 to 5 cents. So this met the criteria. And another thing we had suggested was the volatility. When we are selling options, we want to have a higher than usual volatility, implied volatility. Why is that? Because we wanted the price to go down. And one of the things, as we mentioned, there's a positive relationship between volatility and the price of the options. So if the volatility is expanding, then the price goes up, which is against what I was hoping for, because I wanted this price to go down so I could collect this money and not pay anything to cover it. So the other thing was about historical volatility. So this was implied was higher than historical volatility. So these were one of the reasons that I suggested something like this in this situation going to 25. So from the position of the pricing, that was attractive. But also I looked at, did some technical analysis. So this was one of the reasons was I look at the linear regression analysis. I looked at the last 100 days and I noticed that 25 days is outside the 2 standard deviations. So it made me more comfortable thinking that, well, looks like, it's going to take a lot of work to get down there. So the odds are again in my favor. We also looked at, let me just minimize this. So you could see I did the Fibonacci and we were right at the 38.2 number. It was a support. I looked at where is that 25. It was about, we call it ambush zone between 50 and 61.8. So that gave me more comfort. The stochastics were oversold, embedded, but it looks like we might be turning up. So these are the things that gave me comfort knowing that it was a good trade. The thing is, when we're selling something, whether it's the call or the put, the whole idea is not just being purely bullish or neutral. You want to make sure that it's not going to get there. So, in this case, Uber could have come down to $26, for instance, but as long as it expired above 25 or 25.01, I'm good with it, or 25. I'm still made my money. So it's not just being completely bullish. I don't care if Uber went to $40 or $50. All I care is I don't want to reach that number. So please make that ingrained in your mind that when you're selling calls or puts, you just want to make sure it doesn't get there. The odds are in your favor. That's all it is. So let's take a look at what happened today. So this is as of, let me minimize this. So you can see this is where we were last week. And now we are actually come to the, in this case, 23.8 retracement. And this is where I decided I'm comfortable selling. because, you know, it was 5 cents premium. It's okay because the odds are it might be a resistance, it goes down. For me, making 70, 80%, that's good enough. As you can see, this is what happened to the stochastic. So that was good enough for me. And that's what I got out all of my positions today. So another reason was that this is the 100-day moving averages, all moving averages. That was resistance. So I am very comfortable to be away from my position. So this is where we are. So this is end of the day. I got out at 5 cents. So this is where 25 is. As you can see, the delta has gone to only 3%. So that's pretty attractive. Obviously, I wouldn't buy this now because the premium is very low, but that's very attractive. You can see the implied volatility is at 55, which is still higher than historical. So that has worked. I mean, we want to go, that should go down. That's, we would have made more money. On the other hand, the probability has gone to 3.79 from 15%. So that was pretty good trade. So those are the reasons we did that selling put in Uber, just because of the different criteria that the factors that affected our decision. Here's another reason you will see. Now, if you look at Uber, it's at $32.28. It only moved maybe a couple of dollars, but we collected most of the premium. Now, 32 is 25 is $7 less, and 39 is $7 more, approximately. So when you look at the 32. One thing you will notice when I'm looking at the $39 option, I noticed that the premium for call is higher than the premium for put. So there's skewness. So what that tells me, there is more bias for the call side than the put side. Now we come all the way to the left, and you can see the probability of being in the money is 4.73% compared to 3.79%. And then the delta is actually 6 compared to minus 0.03, or in this case 3. So that also gives us a little more comfort that knowing that there's a bias more towards the call side of the Uber than the put side. So that means the odds are in our favor. If we want to play put side again, it might not be a bad idea. So I just, but technically, as I mentioned, last week was more attractive than this week, for instance. But also you can see there's a lot of volume activity, and there's much larger in this situation of the open interest. So anyway, this was just a review. But again, I want to emphasize, once you understand the selling part of the options, then I think everything else will make more sense. And that brings us to what is vertical spread. As I mentioned last time, again, with the selling put, you have this enormous risk in a sense that the option could go to zero. Can we limit that? And the answer is yes. And that's where this vertical spread comes in. If you can understand what this vertical spread is, I think you will be very pleased to know how many more strategies you could use and have a kind of an income producing strategy that it could be irrelevant or independent of the markets. And a lot of professionals, as I mentioned, they maximize their income by understanding the vertical spreads. Once you understand vertical spreads, then you can do iron butterflies, you can do iron condors, you can do back ratio spreads, you can do calendar spread. So all of these are, again, on the base of buying and selling the puts, understanding, and the calls, understanding that. So what is vertical spread? Basically, vertical spread is an option strategy that involves you actually sell and buy the options of the same types, of the same underlying, with the same expiration date. The only difference is that we could see is it's just a different strike prices. So if it's a September 18, you buy call, let's say on Uber, you buy call of 35 and you sell call of 37. So basically it's the same underlying assets, everything's the same month, except you just use different exercise prices or strike prices. One thing about vertical spread is we mentioned last time you can either buy calls or you can sell calls or you can buy puts or sell puts. Again, that's the four things you can do. And this is a combination of both. So if with vertical, it's either you do both calls or you do both puts. Now, if you're bullish and your outlook is positive, it doesn't have to be overly bullish, it could be even neutral, not neutral, and mildly bullish, then the formula that you remember, every time when you're bullish, you buy a lower price and sell the higher price, regardless of if it's call or put. So if you're bullish about the stock or the markets, you buy the lower price call and sell the higher price, and that finances your lower price because it becomes a debit. So you think that the market is going to go up, but you don't think it's going to go really up, so you finance that. Or you can also use the bullish put spread, and what that means is you buy the lower price put and sell the higher. So in this scenario, let's say again, you buy the put of Uber, let's say that $30 Uber, you sell that part, and then you go, in order to protect yourself, you go and buy the $25 put on Uber. So you have a cushion. And what happens with this, again, the reason vertical spreads are great is when you did that put, the superior put sale, as you see, you didn't really have a floor. Your floor was zero. That meant the company could have gone bankrupt. So let's say we bought Uber and we did that the $25 strike price, that 25 could have gone to zero. That meant you were obligated to buy that $25 option and exercise it, and then immediately you would have lost everything. What this vertical does, it's almost like a stop loss. It puts you a floor. So if you bought, let's say, I'm just using back, let's say you bought that 25 sell, and then immediately you sold that 25 and immediately bought, let's say, 23 on Uber. Now you have a cushion of $2. I mean, below the 23, you have no risk. So the $23 became your floor. On the other hand, if you're bearish about the direction of the stock or your markets, then in this case, you buy the higher price and sell the lower price. So if you think, let's say, if you want to do a bearish call spread, then basically you go ahead and buy the 100, let's say Uber again, you buy the 35 and you sell the 33 to collect a premium. So you call the premium, you buy because you think it's not going to get to 33, but you're not sure. So you want to have that insurance, knowing that you would not lose more than that 35. It goes beyond that, goes to 50, or it gets taken over or something. You have that cushion. So when you're bearish, you actually buy the higher price, whether it's the put or call, the same thing. You sell the lower price, whether it's put or call. All right. Now, why even be talking about vertical spread? As I mentioned, for two reasons. Number one, it limits your risk, which is good because you have a limited amount of, again, you choose. We will talk about which strike prices should you use. We call them the width, the spread between those two. We call them spread or the width of those strike prices. The thing is, because you're limiting your risk, each one covers each other. So remember, when we went and did Uber to sold put, I had to make sure I have enough capital in my account that if I needed exercise 10 times 100, remember, each contract controls 100 shares, then 10 times 100, that meant 1,000 shares. I should have had capital in my account of 1,000 shares to be able to buy Uber at 25. So I should have had, in this case, needed to have $25,000. Now, with vertical, on the other hand, because each one protects other things, the only thing you really at risk is the spread between those two strike prices. And this is wonderful if you don't have the large capital. The company knows that the broker, your broker knows that their risk and your risk is very much defined. It's very much limited between the width of those spreads. So in this situation, it's ideal if you're just starting, maybe testing the options market. And as I mentioned, once you get really comfortable with vertical spread, then you can go do iron butterflies and other things that allows you to have, again, limited risk and a good profit opportunities. So that's why this is ideal for smaller accounts. So in a sense, what I'm going to emphasize more on the bull put spread, because we did last week, we thought, all right, Uber is not going to go. We were selling put, so I thought we would be in the same scenario and say we want to do, we are still comfortable that the stock that we're talking about is going to be positive, so we use bull put spread. So again, remember, we sell the higher amount, the higher, and then we buy the lower put price. So in this case, again, it could have been Uber 25, selling it and then buying 23, and I call it as an insurance. It's almost like an insurance company collects premiums from you, insures all the homes or the cars, but what if there was a hurricane, like it's happening now? They reinsure themselves, they go ahead and pay premium to another company, insurance company, to make sure they're protected, that they don't lose as much. So in this scenario, you sold Uber, you collected your premium, and you said, what if something happened? Then you go buy the put, the lower put, protect yourself. So now in this scenario, when you use the vertical spread, when there's a credit, your maximum profit always, whether it's a call spread credit, call credit, or put credit, is the premium that you receive. That's the premium that when you sold your option, that's what you're going to receive. The maximum loss in this scenario is a little different than the last time. Remember, we talked about if it goes to zero. So in this case, because you do have the floor, your maximum loss will be the difference between those two strike prices, the one that you once you sold and once you bought. So let's say it is $2. So it's Uber 25 you sold, and then Uber 23 you bought. So there's a $2 difference. But that's not really your maximum loss because you did collect some type of premium. Let's say you collected 20 cents. So in reality, you had $2 of risk because that's your floor. And then you collected 20 cents, so you really, exposure is $1.80. And then you multiply, remember, again, every contract represents 100 shares or $100. So 180 times 100, your risk is really $180. Remember, when we talked about just pure put selling, at that time, your width was the price of, in this case, Uber at 25 and zero. Your floor was zero because no company goes below zero. So your risk was 25 minus zero, that's $25, minus the premium that we received was 30 cents. So in reality, my risk was $24.70 or $2,470 for the risk that I took. Okay. So I don't want to go again too much. I think there are just so many other programs you can study on vertical spreads, but I'm hoping this just gives you a little more understanding. So right now, what I want to share is some of my own experiences to give you hopefully the edge, because you have to remember the idea about any type of option playing and any type of investments, nobody knows what will happen next, a minute from now or a day from now or a year from now. What you want to do, you want to make sure you have an edge, you have the probabilities on your side, you want to make sure that you know when to get out, when to get in. So my goal is to just give you that little edge so you can, have a profitable journey. So here's the 7 things that I thought might be useful, again, based on my experience in the past. So the first one you want to understand is, historically, again, because it's a credit spread, you're collecting the premium, and we talked about theta, or the time decay. The time decay is not a friend of when you buy, let's say directionally, you buy something, call or put, because especially last 30 days, we saw the graph last week, the premium just keeps going down, obviously the theta decay. So the ideal situation, if you're doing vertical spread, I would say 30 to 60 days. So looking at that, that's what we look at Uber. Let's say we went to September 18th. It was about 30 days. Because after 30 days, it starts decaying. For me, like 45 days would be the most ideal. So if you're doing, unless you really, now with vertical spread, this works well. If you were doing just a naked put, or you were doing, again, cash protected put, if you really wanted to own the stock, and I have used that example like Disney at 50, then you can go 90 days, just collect as much premium as you want. But with ideal situation, vertical credit spread, I would suggest, more than 30, less than 60. If you do weekly, that's completely different. The market makers really are good at knowing what happens with theta. So, but you also apply that too. So you can do weekly options. In this scenario, I'm working more on the monthly options. And I think that's the ones that we can continuously have like 4 or 5 different positions with different stocks and have a good income strategy with that. The second thing is, you always, because again, this is credit spread. So the volatility is your enemy in a sense that you don't want to have quiet companies with the low volatility, because remember, you're collecting the premium. So you want to make sure you're buying something which was overpriced and it's going to go down. So in a sense, you're selling, what I'm saying is you're selling an overpriced something, and hopefully you're going to buy it at a lower price. So you look for higher implied volatility. And how do you know what is the higher implied volatility? It's, first of all, something that it ranks above. It's historically, they look at the put and calls, and you can go back a day, 30 days, a year. They do an IV rank, an implied volatility rank. Most of the platforms offer you that. Let's say, I think for swim, you will see it. You want to go above 50%. So you want to be higher than average. Now, the thing is, you don't want to have so high that it's expanding, then you're into trouble. I mean, Tesla would not be something that I would do, although there's just so much, premium in Tesla, which is, if you have the capital, it could be a large capital, it would be a good play because so many people are putting so much premium on it. But you want to make sure something is more predictable. And I used the implied volatility is higher than historical, higher than the averages. And your whole goal is to make sure that the volatility comes down. And that's how the premium obviously goes lower. And that's how you make your money. The third thing is, it's interesting, we looked at the risk and return. Usually the risk is, in this case, the money that when you're collecting is much less than the risk that you're taking, because that's the width. The width is your risk. The premium is usually smaller, or much smaller. But remember, you're playing the odds, you're playing the probability. So you get less credit, but you get a lot higher probability. As I showed you in Uber, for instance, nice, like at that time was about 15%. So the odds were in my favor that I will collect, that money will be more in my favor that I'm going to collect and stay with me. Now, I could have used 40% probability, but that meant that, granted, I collected more money, but the probability of having that money or keeping that credit was much lower. So the higher the probability, the less credit you receive. So I'm going to get a little more specific. Now, what kind of a width and what kind of strike price should you look at? So what you look at for the credit, you want to collect 1/3 of the width of the spread. So if you look at the two spreads, and let's say they're 2 points apart, you want to collect maybe 60 to 70 cents. So that's your objective. If there are 5 points apart, then you want to get about $1.60 or so. So this will be your testing ground. So that will be a criteria that you should, it has worked in the past, so it has worked for me. Now, also, what kind of a width you should look at. So there's a lot of, you look at the implied volatility, you look at the probability and all other things. But again, in averages, when we've looked at the probability, if there's like they're 1 point apart, they're 2 points apart, 5, 10. I mean, you sit down and calculate, but in averages, as far as the odds in your favor, we found that the 2 points, and I put down the 2x because the 2 points are, if you have strikes that they move 1 point at a time, like Uber did, right? 25, 26, 27. But then when you get to higher stocks, higher price stocks, then all of a sudden you see they're moving at 5s. Some stocks or indexes or ETFs, they move at 2.5. So I put it here, I put 2x. So if they're not moving at 1 point, then if they're moving at $5, then it seems like the $10 spread is the most attractive, better than $5 spread. $5 are, the odds are actually less, and the profit risk is not as attractive. And then if you use, let's say $10, I mean, 2 times, so it's like the $10, you put that 5 times 2, 10. Now, if you want to do it like a $20, width, it looks like that also, although you collect more money, but the odds are less in your favor. So again, historically, if you want to put like a strategy, 2 times will be the most attractive. This is very, very important. And I mentioned again with my Uber trade is when the flow is with you, go with it and take the profits. I mentioned in my option trading, if it's directional, I always have my targets are made 25, 50, 100 and a runner. When I do the vertical, or if I did that case, we had just a single selling put. In that case, I was happy. I took 50%, 60%. I'm very much aware of the flow. So if the market is going to my direction, I take the profits. I don't need, as I mentioned, squeeze every penny. And I got out 3 weeks early. So that meant that I have a little extra money I can use something else. So what happens with the profits, be impatient. And this is in vertical spreads. This might be contradictory, but with your losses, be patient. So what do I mean by that? Remember, you do have predefined loss. You do know you have credit. As the time goes by, remember, you have a theta which could go your direction. Let's say Uber, in this situation that I had, and let's say I did my spread with Uber. Uber had a big drop. Now, what happened, all of a sudden, I collected 30 cents. My spread is $2. Now, all of a sudden, it's to $1.70, for instance. It's very close to the bottom of my loss, or my stop loss, or the lower, the one that I purchased. In this scenario, don't rush, because you already know what your stop loss is, or in a sense. Don't get out of it. And again, this might sound contradictory, but because time is on your side, as time, Uber might get a really good news, and the next day could go up to your direction. You know what is the worst situation. Even if Uber goes bankrupt, you do have your, again, predefined risk. So don't rush, don't panic if the things go against you in the vertical spread. And again, especially with the credit spread, because you already know what is how much of a risk you're taking. So be patient. If you have to wait till September 18th, so be it. But if things did turn around and now you're getting profitable, there's nothing worse than having a nice profit and then seeing it and losing it. All right. I think that's important. Last but not least is that just be aware of the events, especially like earnings, when you're playing any type of, actually, when you have a strategy for your options trading, especially in the vertical credit spreads, be aware of that because the theta decay actually slows down before the earnings. The volatility actually starts moving higher. So just be aware of that. So make sure that if the stock that you're playing, you want to be aware that, in next 4 weeks, if it's happening, the earnings coming, you want to be out probably 2 weeks prior to that, or at least be aware of it. Okay. So I thought these 7 points might be helpful as far as giving you some direction as far as playing vertical spreads. The other question is, obviously, you always want to find what is the best place and what do I look for? Where do I find candidates for vertical spreads? So I want to share something kind of a basics. You can do it on your own, but I thought these could be a starting point for you. So obviously you've use Finviz because it's free. Again, website. It has wonderful information in it. So with Finviz Screener, you can go and look at patterns. We talked about channeling. So the channels, you can look at when they aren't range bound for months and weeks, or even sometimes they go for years. This gives you this predictability. You could also use moving averages. Let's say it's above 200-day moving average. It has hit that 200 and bounced back. Maybe that becomes your support. So okay, close to 200-day moving average, then it gets, I'm going to sell that and then maybe look at the next supporters and I will buy that, for instance, or look above that. So these are just, again, these are the things you can screen for. You can also look at Bollinger Bands and Keltner Bands. You look at if it's on the lower band and if it's been expanding and what is happening as far as volatility goes. Which we can mix these two with squeeze. If something is in the squeeze, then you want to stay away because the volatility is not, but once it starts moving, and then now you know the bands, maybe you can use that as a criteria. Linear regressions, I showed you before. You can use that against standard deviations. Fibonacci's, you can see the 50% retracement. Maybe you can find those as a support and start selling right around 50% and put your, again, your second width in maybe 61.8. You can do screening like Pinker Swim does, and other things. Look at the high IV screener, look at we have a sizzle index. So these are just a starting point. So why don't I give you one example, which I did, so you can see basically where on Finviz, what I look at, just a basic one, right? Number one, obviously you want to make sure they're optionable and short. You put the short because I like to have obviously the short squeeze coming in. I want to have some companies that maybe they have a high short ratio. So I want to make sure that's available. So that's rule number one. I like to have a liquidity. You want to make sure you're investing in something that has a lot of liquidity. So I put over a 1 million average volume. Also, you want to stock, the higher the better. You don't want to play a $5 stock or $10. You want to have some premium in there. I put 20, but over 20, the higher the better, because you can get a little more juicy premium out of them. But 20 is pretty good because anything above $15, institutions get involved. So basically, I like that number 20. So that's it. These are the three basic in any type of, as far as uh, fundamental reasons that you want to put in. In this case, I decided to use the pattern, and the pattern in this case was a channel. Now you can do channeling up, you can do wedges, you can do triangles, anything with support. You can do head and shoulders, you can do triple bottoms. I decided channel because I want to see something predictable. So I ended up coming with, this is as of today, in today's closing, so I came with the 4 companies. Now, you can see the in this situation, um, uh, this is already broken above. So this is I would not excess, looks good now, it's consolidating, but it's already broken above that upper band, upper channel. This is a little too high. I want to be closer to my lower channel than up here. The same thing here. But we look at, this is SPR, which is, I believe it's an aerospace company. And you can see how many times it has touched that $20. It, granted, the trending line is a little resistance, but this will be something maybe you can explore. Go look into this. The SPR is above $20. It has good volume. One thing I've noticed, I mean, it had a big sell-off, but usually these aerospace companies, they follow Boeing. So they're kind of interrelated. So you can actually look at the chart of Boeing. If you're bullish on Boeing, but you want to play a lower, actually, a little lower risk in the sense of the options play, take a look at this. So, but this is, I just want to show you how it's one of the ways to find some candidates. You could also, again, I mentioned you can use the moving average. You can look at the volatility, look at some high volatility companies, maybe high beta companies that maybe they are getting lower. But this pattern, the channel, I found that very attractive. I found a lot of candidates through them. All right, I hope that's helpful. One question comes out when you have, we do get tempted. When you have vertical spreads, remember, with vertical spread, you have bought one option and sold another. Let's say one of them is really going towards your direction and you can't believe it. It's a, let's say the long side of it. Let's say that you sold the puts. Now, the stock that the stock is really dropping, and you're saying, wow, I'm making a lot of money on the long side of it. Why should I, should I take my profits, or should I sell this, the sell side, and just keep the put side? My recommendation will be, will be 9 out of 10, that because the strategy that you use, these two are married, basically, they work together. I would definitely recommend to stay with it, because the risk, then you are really opening the door for more risk. For instance, if the put option is, obviously it's going to, the purchase side is going to your direction, that means you're losing money on your premium side, right? So let's say you say, all right, you know what? I'm gonna keep, the put side looks really good. I'm gonna keep that because it seems like this stock is just selling off. And I'm just gonna take my loss, because remember, the premium is, you're losing on your premium that you had collected. I'm gonna just pay the penalties or whatever, in a sense, the premium, and then let that go. What if there was like the next day the things turned around and went back up? So you lost money on this one, and then you're losing money on your put side, in the sense that your profits are getting less and less. So in that situation, the opposite is even worse. When you really start selling the purchase one and leave that sell, then it becomes naked in a sense. And that's kind of you own a naked option. So now you're really in a big risk that you have to cover it. So my recommendation is do not leg out unless you're professional. I've done it because I see sometimes I want to, there's, fixing a damaged option that I did, and I play different roles, which we will talk in the future. We can roll it, maybe next month. We want to again fix our strategy if you need it, if there was something you want to do. But as a whole, if you bought them together, you keep them together and you get out together. All right. I hope that answers any concerns that you have. Okay. All right. Now that you're more familiar with vertical spread, what do? Let's say you have a small capital. You're still not very comfortable, but you really like the idea. You think you can do this. So you come to the conclusion that you really want to do that, but do I want to use my own money, my live account? Or is that recommended? Maybe I should do some paper trading. And how far should I go with it? How long should I stay with it? And is it worth it? And then when do I know that I'm done and I should go to real money? So my suggestion to you is, yes, I would recommend definitely start a paper or simulated account. A lot of platforms offer it. I use Thinkorswim. You can see the paper money or live trading. You can choose. A lot of them actually, like Thinkorswim, I think allows you to do like 60 or 90 days without opening an account, in the sense that putting any money or anything. They let you try this. So go ahead and do that, and think of this like a pilot. The pilot uses a simulator. They don't just go jump in and say, I'm ready to fly. Okay, ladies and gentlemen, here I am. I'm your pilot. No, they have to be prepared. So they have to understand all the mechanics of things. They have to understand the emotional side of things and where the things go. They have to feel very comfortable. So I do recommend, especially if you're trying to do options, have a paper account and do it. So once you did it, how long you have to be in it? And what are the pros and cons of doing paper accounts? So the pros of doing the paper trading is, first of all, you learn the mechanics. Simply just doing an option trade, the vertical, mistakes happen. I mean, you want to put I don't know, you start buying, you start press the sell, and things mess up. Well, it's not real money, but this is how you learn. It's about, where do I put my stop loss? Where do I take the profit? So you learn all about the mechanics of your trade. Then you also understand the platform. Some of the things, the glitches, how do I put the moving averages? What do I do as far as this option pain? How many on the columns do I need? What do I look at? What is the, if I wanted to look at the news, where do I go? So here you're not wasting your time, you're actually learning, and it's for free in a sense. So you don't have, again, the pressure, yet you are in a real account, and then you're learning on the job, but also, then you have the pressure of just not knowing where to push the button. You also, with the paper money, can test the different trading strategies, and just a couple of them we suggested. So you can do that. So that's a big pro, in my opinion. It also have, because it's not your money, you also, most of the time, you have less stress. But I wrote this, if not, then you need a thorough self-analysis. Because even after you put the trade in with your no money, and you're still stressed because you think, why did I lose? It's something that you have to work on yourself, because then it becomes a personal issue. I have mentioned before, losing a trade does not equal as a loser. If you do have this big stress, you really have to work that you're still equating your trades with yourself, your self-image, your self-worth. It's not. Your net worth is not your self-worth. In this case, is your net trading is not you. So try to work on that. You gotta get that cobwebs out, that you feel comfortable with losing, for instance. It's part of the trading. So the last but not least, it is important. Things happen. you have two laptops, you have a desktop, you have set it up, and then all of a sudden internet goes off, and then you have Wi-Fi, you're traveling, you're in some developing countries, all of those, this is a good time. It's a slow internet connection, for instance, I put down. It's a good time to find out, oh, this laptop was the best. I'm going to use this. It's a fast processor and all that. So these are the times, these are the pros and cons of, the pros of paper trading. But what are the cons? How long you want to stay in it? The cons are, number one, because it's not real money, then you're not as disciplined as you should be. So you kind of, oh, yeah, it's okay. And you kind of brush the mistakes apart. You have to approach it as really, this is a limited time. This is a real study, real education, and you have to approach it as real. So that's one problem I've seen in the past. The emotional consideration, the reason I say this is because there's no real money involved, sometimes your connection with the trade is not as intense. So, which that was a pro in one sense. On the other hand, it's not. So this is where you have to find yourself when there's a real money. When I used to, teach, I had some students, and I would put the $100 bills right on the floor or on my desk, and I say every time, the strategy you're using, you're losing it, and I would say, I'm going to rip this 100 and throw it in the trash can. After 2 or 3 of them, it hits home, because every time you lose, it really feels completely different when there's a monopoly money. It's not real money. So that's also important, that you don't want to be in a comfort zone and do this for a year and say, oh man, I'm great. I'm making tons of money. I feel really good. I am invincible. Now I'm ready to go and invest millions of dollars because I know I make that million becomes 10 million. I make that 10,000, it's like no time it's going to be a million. No, that's what the emotional consideration should be, play a big role. This is also a big important one, especially in options. It's the slippage and other trade-related issues. And why do I say that? What happens when you are trading options on the paper money or the simulated accounts? You put the trade in, because there's nobody really on the other side. It's a computer. It's like you get filled at no time. Wow, it's great. You put the limit and it's filled right there. The volume doesn't really change. So even if you put 100 trades, it doesn't show that you affected the price. So, but once you do an real option, that completely changes, because now you start sweating. Oh my God, why am I not getting filled? Why they're not giving me that price? The day ends and you're still not filled. So the slippage, as I mentioned, or any other related issue is not with the paper money, because you get, man, life couldn't have been better than this. So that's what you have to take into consideration. As a matter of fact, one of the strategies that I use when I'm doing options, if there's a market maker is again, on the other side, and when I get filled really fast, I start sweating, because I wonder why this option, the market maker want to get rid of the inventory so fast. With the simulator or the paper accounts, you don't have that concern. You don't know what. So that's what sometimes I use, like a little strategies to see. I kind of put one contract to see if that gets filled, or I start playing around. So when I see there's a little delay, then I know that the market maker maybe is sweating. So this is a good trade. The odds must be on my side. So that's nothing to concern. The other problem is, it makes obviously sense in the sense that because you set up your simulated account with $1 million. I don't know, it's paper money, and you can take all the risks. You get these penny stocks. You get really big option plays that you would never do in real life, and you just take risk. On the other hand, you don't really do your due diligence. You don't do as much research on things. And what happens, basically, then you really are not building good habits. And that's one thing I found again, a shortcoming of doing paper money. So when is a good time? How much time you should put in? I would say at least 30 days, maybe 60 days, but I would suggest maybe 60 trades, 50 to 60 trades, like maybe one trade a day. So that will take you maybe again in 2 months, takes you 50 trades, 60. I think by doing one trade a day, it gives you that good habit. Again, if you have a good foundation, I think after 2 months, at most 3 months, you should be pretty much ready to go. And yeah, I wouldn't wait too much longer than that. With that in mind, I think I appreciate it's exactly 6 o'clock. So I very much appreciate you being with me. So with that in mind, Sean, we can stop the recording, and I'm ready for any questions and
I
comments.
pass the host to you. Sorry, you can
Oh,
close it.
I
Thank you.
don't see the recording. I haven't been I thought you were recording this, Sean. Hello, Sean. Hello. Can anyone hear me?
Yeah,
Ramin, I can hear you. Yeah.
Oh, Sean, can you hear me? I don't know what happened. I hope it was recorded because I heard it.
there's a recording symbol on the top left. So
Yeah.
sure.
I think it was recording, Ramin. There's a,
Oh.
like Kenneth said, there's a symbol saying it's being recorded.
Okay. I don't. Oh, stop recording, I guess. Oh.